back. You tune into Markets at Noon with me and Peter Sikkanad with me, Sahisha, and we are getting you what's transpiring in the market and how should you be looking at this market and placing your bets. And for that, we are now joined by Abhay Agarwal, who's the founder and fund manager. Piper Sarika, who's joining us. Hi, Abhay. Good afternoon to you, and thank you so much for joining us today. Abhay, firstly, I was reading through your portfolio, and I see that you're very positive on pharma, autos, and you're cautious on FMCG and IT stocks. So the classic debate of value versus growth, you're clearly tilted towards the growth side because the kind of picks the pick side that I can see, because the focus right now is on consumption, right? The kind of boost that we are seeing for consumption, we will see a pickup in consumption, and therefore incrementally FMCG has a chance because FMCG hasn't really done also much. But you are cautious on FMCG and IT where there is a valuation comfort, but clearly you're tilted towards pharma and autos. What is making you so positive on them and so cautious on IT and FMCG?
Yeah, good afternoon, and thank you for having me on the show. So I think when we look at valuation, we look at it through an additional filter of growth. So what happens is that when people typically look at only one metric, which is the PE multiple, they miss out on growth opportunities, because what we have seen is that the multi-baggers come from high growth companies, and these high growth companies, when they are on that rapid growth curve, typically trade at a premium multiple. But when you start building growth into it, you start seeing a PEG ratio of, let's say, 1.5, 1.7 times, which is fine, compared to some of the slow growth companies or sectors like FMCG is a classic example, IT services struggling for 2 to 5% growth. Now, these companies, when they trade at 20 times PE multiple, and in FMCG, even 60 times PE multiple, when you look at their PEG ratio, you will find that, an exorbitant PEG ratio. Whereas some of these other young companies that are growing fast, the PEG ratio is still very sensible, 1.5, even 2 times. But it's okay to pay that because the growth will make the returns, for investors. So that is why I think in India is a growth market. That's how foreign investors also see India. And we have always made money backing growth, high quality growth. So we are not so worried about optical valuation being high, as long as we can clearly cite growth for next 3 to 5 years.
So that sounds good. Mr. Agarwal, let's talk about what the next market trigger could be. Because remember, this time last week we were almost very close to touching our fresh all-time high on the Nifty. We've receded after that back to around those 26,000 levels. But keeping those numbers aside, despite seeing a better than expected earnings season, we've not seen that kind of fillip that the market requires to get out of the range. The US-India trade deal also is a little far away right now in terms of some more clarity. What do you think the next market trigger could be, and by when do you think the FIIs could make a comeback, and if that is incremental enough to get markets out of a range?
Yeah, I think you said it pretty well. I think fundamentally we are in a very strong position. Corporate earnings, which were slow for a year or so, have picked up very nicely over the last quarter. And I think the current quarter that we are in, we will see a further improvement. So we are not worried about growth coming back. I think the growth is there. Management commentary is also positive. There was a lot of caution earlier, but across sectors, we are seeing, especially consumption, that the growth is clearly coming back. Now, why the markets are not responding to that? I think the reason is largely technical, and that technical reason is the constant selling by FPIs, and FPIs are still a very big part of the market. We can't wish them away. We can't say that, look, it doesn't really matter whether FPIs are there or not. It's an important source of capital that our market needs. And this year we have seen a constant selling pressure by FPIs, which is not abating, and I think the key reason for that is less to do with India and more to do with the fact that the US markets themselves have outperformed massively emerging markets this year and continue to do so. Any correction in the US is being bought in. So it's quite natural that closer home, the markets are more attractive. We have seen The share of US in the global MSCI index has gone from 65% to 72%. So unless that reverses, and I think that will reverse only when we see some correction in the US markets, uh, I think India's earnings growth will be attractive, but will not be the sole factor for pulling capital back into India. I think, frankly, my read is that the US markets need to correct for money to come back to emerging markets and India. When that happens, I don't know, but I'm guessing that could be, sometime towards the end of first quarter next year. So till then, I think we will continue to be in the consolidation zone, which is good in a way because it gives domestic investors a great opportunity to add high quality growth stocks at pretty reasonable valuation to their portfolio.
Right, Mr. Agarwal. So you say that fundamentally the reason why the markets haven't really moved is because of the constant FII selling, and therefore, let me ask you your view on the large caps and small and mid caps, because clearly, if when FII is selling, they're selling in large caps. So would you find more comfort in the small and the mid caps then?
Yeah, I think the way we look at it is that currently we are at around a $5 trillion market cap, $5.3 trillion market cap, and let's say we are going to add another $5 trillion to that market cap over the next maybe 7-8 years based on the current growth rate. So where will this incremental $5 trillion market cap come from? I think maybe 35% will come from the existing large caps, because again, they are also not growing as fast as they used to. The remaining will come, the large part, 65% or two-thirds will come from companies that are currently small and mid caps and will become large caps over the next 5 years. So I think that is where the opportunity for investors, long-term investors is. Large caps definitely will give return, but their return over 5 to 8 year cycle will be lesser than the small and high quality small and mid cap. So that is where our focus is, because our money is not really short term money, so we don't react to short term changes in markets. But we are looking at more opportunities in the small and mid cap space, because that's where growth is. We are seeing companies that are guiding for a 20 to 25% annual growth rate over next 5 years, 3 to 5 years, with improving margins, improving return ratios, better balance sheet. So I think those are the companies we would like to back. Large caps have a space in the market, definitely do less volatile in tough times. But I think investors come into the market to make return, multi-bagger returns, and that will come from small and mid caps.
Okay, so seems like SMIDs is the way to go. Thanks so much, Mr. Agarwal, for your time today. On that note, we'll let you go.
Thank you.
Okay. On that note, viewers, time to slip into yet another very short break. But on the other side, we'll start interacting with some corporate voices. So you stay tuned and we'll be right back.